Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to a cash budget and cash receipts schedule. Get ready, it's time to take your chance with Corporate Finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access to it and we would like to, we are in the 434 Cash Budget and Cash Receipts tab in the Practice Problems section. Closing this back up, we're going to go through the information up top and we'll read through that information. Then we'll have a smaller component of that information we can use to then work through the practice problem. So we have the projected sales for September, October, November, December. We will be focusing in on November and December. We need the September and October information in order to work through the cash receipts schedule. So we're focusing in here on November and December for the cash receipts schedule, as well as the cash budget that we will be working. We have the percentage of cash sales is going to be 30%, meaning we're talking total sales. The percentage of total sales that are just going to be for cash, 30%, meaning the 70% then are sales that were made on account. So we issued an invoice, got accounts receivable, and we'll have to collect on them. So the cash sales, when we think about the cash flow, of course, we will have received the cash at the point of sale. If they were a credit sale, then we're going to have to think about, well, when are we going to get paid on the credit sales? So percent of credit sales paid in month after sale, we're going to say 40% will be paid after the month that we had the sale in. And the percent of credit sales paid 2 months after will be 60%. So 2 months after the sale, we're getting 60%, which is kind of high. We'd like to collect on a little bit faster on this. We're working on that, but that's where it is at this point in time. So on the credit sales, we got a 40-60. That, of course, adds up to 100% collected on them the month after and then the following month after that. We have the cash payments for November and December. Being the $16,000, the $9,005, those just being given to us at this point in time. As we use this information for the cash budget information, we'll talk about in future problems. We will look at the cash receipt schedule, cash payments schedule in more detail in a more comprehensive problem, and then get to the cash budget. But for here, we're going to have the cash payments being basically given to us for November and December so that we can calculate our cash budget. The beginning cash balance for November is going to be the $5,000. So that means that the ending cash balance for October would be $5,000, which we're going to use in the period that we're focusing in on here. That being November being the beginning balance for the period we're focusing in on, November. Desired minimum cash payment is going to be cash balance is going to be $5,000. In other words, we want to have $5,000 in our bank account, and if we dip under that $5,000 threshold, we're going to take out a line of credit or a loan in order to get us and meet that $5,000 mark. So that's going to be our minimum, that if we dip under, we want to have a loan to get us back to that point. So we have a smaller recap of our information here. We're going to start it off with our cash receipts schedule. And so we're going to have cash receipts. Now I'm including September and October, even though they're outside of the scope here, because we're focusing in on November and December so that we can see any calculations that might be needing a prior period will be there. If you're doing this in a practice problem, once again, remember that if they give you more months than are in your schedule, you're like, well, you're focusing in on November and December. Do I need to add this column or not is the question that would be happening when you're writing this thing out. If you're doing this by hand, then I would say, yeah, let's include the 4 columns just in case you need them. And if you don't need them for the cash receipt schedule, for example, what if these 2 items are only needed in the cash budget and you don't need them for the cash receipts and you don't know that until you start putting this thing together? Well, then that means you just wouldn't use these 2 columns and that would be fine. So if you're doing this by hand, you might as well put the columns in there and use them if you need them because you can't really add them later. It's more of a problem to do that. If you're doing it in Excel, you can add columns later. But still, it might be easier to delete columns than add columns, so you might want to add those and then trim this thing down as needed. It's useful to have these added columns, even though they're not in the calculation of the month that we are in, so that we could standardize the calculation. If you were to do them in Excel, you can then copy and paste formulas using that format, and if you wanted to hide those columns, you can then hide them for presentation purposes. Okay, so then we're going to have the sales are going to be the 11.2, the 13,000, the 21.2, the 17.2. Then we have the credit sales. So of those sales, so those are going to be the actual sales that we have. We're going to figure out the sales that are going to be on account. So we were given here then the cash sales are 30%. That means the credit sales are going to be the 70%. So in other words, obviously 1 minus the 0.3 is going to be the 70% times the sales number. So we'll say times the sales number. For the case of September, it's going to be 11200 is going to give us that 7,800. If we look at October, then we're going to be picking up the sales number, the 13,000 times 0.7. Hold on a second. I did something funny. Had a finger hit two places. Times 0.7. That's going to give us the 9,1. Let's do one more since I kind of messed it up. 21,2 times 0.7. And that's going to give us our 14,840. So these are the sales that we had on credit, meaning they're going through accounts payable, and we're going to have to figure out when we're going to collect on them, which we're going to assume 40% 1 month after, 60% 2 months after. So then we have the collections. Now we can look at what we really wanted to get to, which is the cash inflows here. So we got the cash sales that took place. So the cash sales, then you can calculate this two ways. And notice now we're focusing in on simply November and December, the period we're focusing in on. That's where our what we wanted to budget out for. We can think of September and October basically having already passed. You could say, well, if the total sales were 21,2 minus the credit sales of 14,840, that means that you have the cash sales of 6,360, or you can take the 21,2 sales times the 30% that were the cash sales, because the 70% was over here, 70/30. So that would be another way to get to that 6,350. Same thing can be done, of course, with December. Then we got to go to those credit sales. So now we're going to consider the ones that were actually sold on account, where we're saying we're getting 40% the following month. So now we're going to think about these credit sales, and I'm going to say this is 1 month after. So let's look at this number for November. We're going to be looking at the credit sales for October to get it. So we've got the 9,100 in October credit sales times the 0.4. That's going to give us the 3,640 of the collection that will happen in November. And then if we go on over to November and December, we have the credit sales of 1,4840 times the 0.4 is going to give us the collection in December related to those sales of 5,936. Then we said that 2 months after, we're going to collect 60%, which again is kind of high. Like we would like to be collecting like earlier than that normally, and we're working on that. We've set in some policies and but right now we're collecting 60% 2 months after. It would be really helpful for cash flow if we can trim that down a bit. But so that's why we need the September here. So September, we're going to be picking up then the 7,840 and multiply that times the 0.6. That's going to give us our 4,704. And then October, we're going to be taking the credit sales of 9,100 times the 0.6. That's the 5,460 here. So then we can think about our total cash inflows, the cash receipts, being these three numbers: cash sales, and then the receipts on the credit sales, 14,704, 16,556. So now that we have that information and we know what the cash outflows are, because they're basically just given to us in the problem for November and December, we'll go to our cash budget. We're focusing in once again on November and December. So now we can pick up our cash receipts, which we have up top. We just calculated the cash receipts. And notice when we think about this cash budget, well, you might think about this, you're probably thinking, well, we should start with the beginning balance, then have the change, increases and decreases, receipts and payments, and then that will give us our ending balance, right? But we're going to kind of reverse it here because we're tying into the schedules that we had as one reason you can think about why we would do this. We want to focus in on the schedule, so we're going to look at the flow first. So we're going to be picking up the numbers from the flow first, meaning the change, the receipts, and then the payments. And then we'll be adding up the beginning balance to it to get us to the ending balance. And we also then want to think about that minimum payment to see if we ever dip below the $5,000, so that if we do, then we want to take out a loan so that we're capped out at that $5,000 minimum amount that we think we want to have in case, just as a cushion of cash. So then we're going to have the total cash payments that we have that were given of the 16,556 $9,000 and the $9,005, which would be on the cash payments schedule. And then we have the net cash flow being the subtracting these two, 14,704 minus 16, meaning there's a net outflow, but that's okay because we have a beginning balance we haven't added in yet. And then we have a net inflow in December. And then we have our beginning balances that was given to us for the first period, meaning 5,000 for November. This 5,000 is the one, meaning as of the end of October, we had a $5,000 balance. So that's going to be and the ending balance. So that's going to be our beginning balance for November, the $5,000. Then we have the cash balance before the loan consideration, cash balance before the loan consideration, and try not to focus in on December here because at this point in time we're focusing in on November, and then we'll go back on over to December. Okay, so then we have the cash balance before the loan. We had a net loss or a cash outflow, a net outflow of 1,296, and then the beginning balance of 5,000. That means we're at the balance in cash of 3,704. That would be our ending balance if we weren't considering any loan. But that 3,704 is going below the minimum balance that we want to have, which is 5,000, and therefore we're going to have a line of credit or a loan that's going to kick in, bringing us to that minimum balance of 5,000. So we want the loan to kick in. We're going to need 1,296. Why do we need 1,296? Because that's the minimum balance of 5,000 minus 3,704 of the 1,296. So that we can then take that loan, that's the loan we're going to take out to get back up to that minimum balance that we want to keep on hand of the 5,000. And so then we're also going to track the loan balance down here and just say, okay, now the loan balance is now at the 1,296 that we're going to have to pay off. If we have excess cash in the future, we'll then pay that off. So now let's do our little reveal thing over here, even though you saw it, but you weren't concentrating on it, so you don't know what these numbers are yet. So now we have our ending balance, and that's going to be our beginning balance for December. So notice that we didn't start it at the top. You might say, I would like that at the top. That's where we should start in the next month. But no, we're going to do the change first, and then we get that ending balance, which puts us right next to the loan kind of amount. So we're going to do it a little bit reversed here, right? We got the change first that's going to happen. Then we have this change in the flow of 7,056. That's all stuff that happened in the current period. Then we're going to add to that the beginning balance. So now we're going to add to that the beginning balance, which of course is equal to the ending balance of the prior period. And that's going to give us the 7,056 plus the 5,000, or the 12,056. Now we don't need to borrow any money because we're over the $5,000 threshold, but we already have a loan outstanding and we can pay off that loan now. So now we're going to say, all right, we had a line of credit. We're over that point, so we want to basically just pay that out. We're going to pay out the entire amount of the 1,296, bringing the balance of the loan down to zero and bringing our balance in the cash account from 12,056 down by 1,296 to 10,760. So that's what we have in cash now. And then our loan balance is back down to zero because it's going to be this 1,296 minus the 1,296 here. Now, I highly recommend, once again, to do these in a spreadsheet. Do these in Excel or do them in Google Sheets. If you have an Excel sheet, if you have the Excel sheet available to you, but you only have Google Sheets, you might be able to upload the document to Excel to Google Sheets and just be able to work it there because you can. It's really useful to practice these types of formulas within a spreadsheet program.